The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and I am going to be talking about money. Al is on vacation, taking some well-deserved time off, but it's up to me to give you what needs to be talked about today. And that's what I want to talk about. You know, when my son was in his teens, we visited Paris, France, and we walked through the Louvre. And I said, you know, you can pick up things looking at the paintings. A lot of people will look at the paintings, and they're marvelous to see and so on. But I said, there's something else going on here that if you look, you can see. You can see and follow the money. I said, think about it. The early paintings are all ones that were done about the Christian church and about Bible paintings. Because the church had the money, the artists got paid and commissioned to do their paintings by the church. But as you move along, you see a change that begins to happen, and you begin to see pictures of kings and royalty. And I said, now you can begin to see that the money moved from the church to the royal families. And as you move further along, you could see it continued to spread out into the courts and the people that were involved with the king and with the nobles. And you saw it spread further, and eventually you see it reaching into the merchants as you get to a period of time in the 16 and 1700s. It was the merchants who were having their families painted. I said you can follow the money. There's nothing scientific about it. There's nothing law about it, but you can follow the money. You can look at that. And I say that because you can follow the money. You can look at that in terms of investment cycles. That's a very long cycle that took place. That was 17 or 1800 years. You can see the patterns that were taking place. But it's more than just about patterns. I began my professional career working a summer at Pacific Gas Electric in San Francisco. I was hired into the operations research department. And in that department, it had been forecasting electrical consumption in the future for decades. And the way that it usually worked is that they would take out last year's forecast. They would count the number of dividers in the book. They would count out that number of dividers for this year's book, and they would put it in. But computers were arriving on the scene, and computers could calculate a whole lot of information and do a great deal of analysis. And that's what that forecasting group came. It's a very important aspect when you're talking about an electric utility, because if you overbuild, you end up raising money which gets no return. If you underbuild, you end up with brownouts. So forecasting was really important. And at that time, the big thing that was happening in operations research groups was to do linear regression. That's where you say if you have one variable, it determines what another variable is. And since this was a brand new project, everything started rolling along, and we threw every variable, every bit of data we could find and ran it against electrical consumption. And what we found was almost a perfect correlation for electrical consumption in Northern California. It was correlated 0.97 or 0.98. I don't remember the exact number, but the correlation was extraordinary. We talk about correlation when you talk about the correlation of assets, when you talk about those sort of things in building an asset allocation model, which we don't believe in, but that's another subject. But that's where it was born in terms of linear correlation. If A happens, then B happens. That's what linear correlation was. And we found something that was absolutely the best predictor if you looked back of electrical consumption in Northern California. And what it was the number of prisoners on Alcatraz. The number of prisoners on Alcatraz reflected exactly electrical consumption in Northern California. Now, if that was true, if that really held, then today there would be no electrical consumption in Northern California. But that taught me a great lesson when we saw that, because that taught me you can't just look at the numbers and depend upon the numbers. You have to look at the reasons behind the numbers. You know, that's as we look at economics, as we look at the stock market, there's a lot of people that make a lot of charts and graphs and back test, and they do all those things, and they come up with forecasts for the future. You really have to know what the numbers are. Otherwise, you end up looking at the number of prisoners on Alcatraz, forecasting the market future. That's economics. There's a lot of people that would like to think that economics is governed by laws. I talked about that before one time because I was at the conference, I was a speaker at the Northern California Wealth Management Forum. And at that forum, people looked at the perfect trade. At the beginning of 2023, you couldn't get any better trade than they were forecasting. And this is the whole thing, is the Fed was raising interest rates at the beginning of the year, had been raising rates through 2022. The yield curve was inverted so that short-term rates were higher than long-term rates. And during that period of time, things got even better for the trade because Silicon Valley Bank collapsed, Republic Bank went away, and there were a lot of questions about the solvency of the banking system. It seemed like the perfect trade at the beginning of 2022, and that was reinforced with the banking situation. And that perfect trade was to sell all stocks and to buy bonds. Buy those short-term bonds. You could get 5%. You could essentially go to 5% and wait for the stock market to crash. And for sure, with the Fed raising interest rates, with the yield curve inverted, for sure there was going to be a recession before July of 2023. There was no question. Economics does not follow the same rules and laws as you find in physics. Albert Einstein stated that the speed of light when you measure it in a vacuum is constant. It's always going to be the same. It would be, that if you take a 10-pound ball, steel ball, and you throw it up in the air 10 feet, it's going to come back down. That's the law of physics. There were people at that conference, and I probably was the only outlier, the only person that had a different view, but almost everyone had the same view, that it had been time to sell the stocks and buy those bonds. And they treated economics and the stock market just as Albert Einstein would have treated the speed of light. It's constant. Only it didn't work. The bonds, sure, they got 5%. On an annualized basis, that's 2.5% for half a year. But the stocks during that period of time, they didn't go down. We didn't have a recession. The stocks actually went up over 16%. So those people that were 15, 20, 30 to 50% and more in short-term bonds lost out. There are big trends, and it's important to follow the trends. And I've been doing trends since the very beginning of this radio program. Actually, before the radio program, that's what I look at. Mark Twain said, history doesn't repeat, but it rhymes. And so there's things you can learn from history, but it doesn't mean they're always going to be the same. The Fed raising interest rates, the yield curve inverting. You can learn and historically see the impact of that, but you can't count on it as Albert Einstein could count on the speed of light, as you and I can count on the speed of light, as you and I can count on gravity pulling that 10-pound ball back to Earth. It doesn't work, but there are themes. And I want to go through some of those themes and get you to the last theme because it's important to understand. I started by talking about Dow 100,000. At the time I started talking, the Dow was at 10,000. And I started talking 10,193 on the radio program of May 21st, 2010. I talked about the Dow reaching 100,000. At that time, it seemed a lot more pie in the sky than it does today at over 30,000. In 2012, I started talking about the supercycle and what goes on with the supercycle. The Dow was at 12,000. And then in 2016, I said, people need to prepare for inflation because there's a very good probability we're going to see inflation coming. In this secular bull market we've been in since 2009, we're going to see the secular bull market come to an end. And there's ways to handle that. And I'm going to talk later in the program about how to get through that. And we've talked about that before, which brings us to the last theme is that things have never happened before, happen all the time. So it's important to know how to hold them, when to fold them, when to walk away, and when to run. History doesn't repeat, but it rhymes. And so the first theme, Dow 100,000, that was straightforward looking at the Dow. It begins in the lower left-hand corner and goes to the upper right-hand corner. The Dow on January 1st, 1900 stood at 66. At December 31st, 1999, 100 years later, the Dow was 11,467. Went from the lower left-hand corner to the upper right-hand corner. That's the kind of industry and the kind of economy that we live in the United States. That was the first. The second theme, I said, began in 2009, began as we were coming out of and the Great Recession. It was the theme of the supercycle. And I talked about it every 2 or 3 months for a long time because it really it was really happening. And to understand what was happening in the stock market and in the world, you had to understand what was happening in that super cycle. We're coming to a commercial break. Don't go away, because we're going to start back with the super cycle, and then we're going to continue on with some of the other themes, because it's important to understand the themes as we go forward and what to do in this very difficult time that we're entering.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
History doesn't repeat, but that it rhymes. I've been talking about that and talking about the themes. When I started doing the radio program, and even before that, I look at large themes that are going on in economics and in the stock market, and look at that in terms of the macro background as we select on the micro and choose stocks that fit changes in technology, demographics, and lifestyles. But the first change, the first big cycle that happened, and we're talking about cycles, we're talking about long-term things. Standard Chartered Bank of the UK, large bank, 80,000 employees, they did a report that found that there were periods of time when worldwide GDP growth was above average, and those cycles lasted for a long time. The first cycle, from 1870 to 1913, 43 years, and it was driven primarily by the industrialization of the United States. Yeah, during that period of time, we went through 6 financial crises like 2008. But it was also a time of industrialization. We moved from being 50% of the people on the farms to being an industrial nation, a powerful growth, difficult business cycle, and a shift from London being the financial center to the United States, to New York. The second cycle began in 1945 and lasted for 35 years to 1970. And it was driven primarily by the reconstruction of Europe after World War II, by Asian exports, relatively benign business cycle, but those companies in Europe rebuilt, Japan rebuilt. We had the Cold War and things going on during that cycle, but it was a very good time for GDP growth. And the final cycle, they said, was a cycle that began in 2009, expected to last through 2030. So we're still in that cycle, that third cycle, and it's driven by the emerging countries, especially Asia. And the winners were going to be global: China, India, Brazil, Indonesia, Russia, Turkey, Sub-Saharan Africa, the Eastern European countries. All of those were part and are part of what's happening in this super cycle. They're moving from subsistence to consumerism. And we've talked about some of the things that have gone on, but it's a tremendous time of change. If you look at the United States and where we stand, 50% of the revenues from U.S. companies, the companies in the Standard & Poor's, 50% of their revenues come from those emerging nations and from overseas. 43% of all revenues from all companies, I should say, come from overseas sales. So it's a significant impact. It's not just that's happening over there and this is what's happening here. No, it's something that's going on. And what drives that is the change in poverty. If you look, 1820, 94% of the world, including the U.S., lived at poverty levels, $19 a month, $228 in today's dollars terms. Tiny. By 1870, 87% of the was in poverty. But that was the beginning of the first super cycle. Second super cycle, 80% of the world was in poverty. Today, it's shrunk considerably. By 1945, the second super cycle, still 73%, but over 20%, 7% of the world had moved out of poverty, and that was driving those super cycles. By 2030, the estimate is that 93% of the world's middle class will be living in those developing countries. Now, middle class is a broad spectrum, but they're moving from consumerism. And I talk oftentimes about a client that I had early on, late 80s, early 90s, who was the plant manager of American Standard plant in Tianjin, China. They had 1,000 employees. They were building ceramic toilets, ceramic bathtubs, and ceramic shower stalls. 1,000 employees. Not one of those employees had ever seen, let alone used, a ceramic toilet, a ceramic shower stall, or ceramic bathtub. And they were building it. Today, those same 1,000 people, they all have cell phones. They drive cars. They buy their clothes at the stores, and they buy their food at grocery stores. They buy lattes, probably, too, from Starbucks. It's been a dramatic change. That's in China, but that's happening around the world. And that is a super cycle that's continuing to roll on and continuing to impact what we're doing. But I said the second theme that was coming up in 2016, I said the big theme that is going to be coming up and that people need to prepare for is inflation. Inflation is coming. And if I look back in the 1960s and the 1970s, because in 1962, inflation stood at 1%. It would reach 13.5% by 1980, but it was just 1%. And it went 62, 1%, 63, 1.3, 64, 1.3. It was fairly benign, just like what we have seen up until recently. But I said the same things were going on in the 1960s, the mid-60s, as we've seen happening today. And what's that? In 1965, we saw the Great Society happen. 1963, 1964, 1965, the Great Society. Tremendous changes going on. We saw the adoption of Medicare. We saw changes going on in terms of the civil rights movement. And we saw tremendous changes happening in this country in terms of technology, in terms of demographics, in terms of lifestyle, and the government putting out a lot of money. What we saw coming out of the Great Recession is a lot of stimulus, and that was further augmented in 2020, of course, with the pandemic and in the bills that have followed since then. All of that spending by government, and yes, important things happened during that time. And yes, I believe that a lot of that needed to happen. But what it does is it begins to create a pool for inflation. And since 2016, I've been saying we face a potential time inflation. Lowering taxes in 2017 did not help the situation. It made it worse because the government continued to spend at the same level while taking in less money. That's a pattern that augments the potential for inflation. And if you look back in the 1960s and 1970s, and history doesn't repeat, but that it does rhyme. If you look at what happened, William McChesney Martin was chairman of the Fed at that time. He was appointed by Truman. He was reappointed by Eisenhower. He was reappointed by Kennedy and then by Johnson. But when Nixon came to power, he appointed Arthur Burns. Now, if you go back and you think about where we started with this program, with the Fed raising interest rates, that's what William McChesney Martin did in the late 60s. By the late 60s, inflation was picking up to 3 and 4 and 5 and reached almost 6% by 1970. And Martin was raising interest rates. He was slowing down the economy. And sure enough, a recession was following. There isn't a period of time where there is no logic to the Fed raising interest rates and you end up with a recession. And yes, the yield curve was inverting and there was a recession. There's reasons why that's not true today. And we'll talk about that later in the program. But at that time, Martin was raising interest rates and inflation was beginning to drop. It dropped from 5.7% in 1970 to 4% in 71 and 3.2% in 1972. And as that was happening, as Arthur Burns became chairman of the Fed in 1972, he did what people talk about the Fed doing now, beginning to lower interest rates. Inflation was coming under control. The Fed was beginning to lower interest rates. They were doing it then because we had a recession taking place and inflation seemed to be under control. All would have been well had it not been for the Shah of Iran and OPEC. And the Shah wanted higher oil prices so that he could buy more military equipment and weapons to rebuild the Persian Empire in Iran. And OPEC went through an oil embargo to raise the oil price. And suddenly, inflation, instead of going down, inflation took, and by 73, it had doubled. By 74, it had doubled again. And inflation was on the upward. And now you had two things going on. You had a recession going on, and you had inflation going on, what came to be known as stagflation. The economy was stagnant, and yet we had inflation. What you would expect is with a recession going on, the economy would have been going down. Instead, because of commodity prices We had inflation continuing to go up and the economy coming down. That's the lesson we learned from 1960s and 70s. We learned that what people thought, or what people think today, the Fed raising interest rates and the yield curve inverting, would lead to a recession. And you'd think that that would be the case today if it wasn't for other factors. But you have to consider other factors. As I mentioned in the beginning of the program, when we did the linear regression, the number of prisoners at Alcatraz reflected exactly electrical consumption, because as Alcatraz actually increased its population, that was in parallel with what was going on in California, Northern California. So there was some parallel things going on, and there were parallel things going on with inflation. That was going on then, and that leads us into what is going on now. Because we have the super cycle, we have a growth time going on worldwide, but we also have a period of inflation. That is going to do some of the same things that we saw in the 1960s and 1970s, and we're going to talk about that when we come back from this commercial break, so don't go away. We've got a lot more to cover, so much more to cover.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
I've been talking about the themes, the overlying themes in economics and in the stock market. They drive on a large basis, on a macro basis, what's going on. And no, I'm not talking about looking at the macro curves and so on. I'm talking about actual GDP, actual growth things that are happening, things that are affecting changes in technology, lifestyles, and demographics. I've been doing this for a long time, and I mentioned at the beginning of the program, I started this in 2010 with saying Dow 100,000. If I go back even before that, I can say it really started in the 1990s when I said that the 19th century, the 1800s, was the century of chemistry. The 20th century, the 1900s, was the century of physics, and this is the century of biology. It's a long-term theme, and we're going to see those things happen. Dow 100,000, that was the first thing. The second thing I talked about was the super cycle, those times in which worldwide GDP grows at a more rapid rate than average. The first super cycle, 1870 to 1913, 43 years, driven by the industrialization of the U.S. Second super, 1945 to 1973, 35 years, anyway. 43. That was driven by the rebuilding of Europe and Japan and the decolonization of those countries. And that super cycle, I started in 2016 saying prepare for inflation. And we learn lessons. History doesn't repeat in economics or in history or in the stock market, but there's lessons to be learned. It does rhyme. And we can learn from the 1960s and the 1970s. One thing we learn is inflation lasted for a long time. We expect it will continue to last for a long time. We've been saying that since 2016. And what we saw in 1960 to 1980 is that the dollar lost 70% of its purchasing power. What that meant is on the average, what cost $1 in 1960 to buy cost $3 in 1980. In 1960, a first-class stamp was 4 cents. You know what it is today? Somebody just told me it was 90 cents. I don't know if that's true or not. I have no idea. I don't buy the stamps. But going back to 1980, a first-class stamp was 15 cents. It almost quadrupled in price. A Coca-Cola was 10 cents in 1960. It was 35% in 1980. A dozen eggs cost 57 cents a dozen in 1960. A dozen eggs cost 91 cents a dozen in 1980. And today what? Eggs cost $8 a dozen? $8? Anyway, gallon of milk, 1960 was 49 cents. In 1980, $2.16. That's what happens to purchasing power. If you look at the purchasing power that we've seen that's been lost since 2000, in those items that consumers buy, 30% of purchasing power has been lost. What that means is what cost $1 in 2000 now cost $1.80. And the fact is, it's only going to get worse. Had you put all your portfolio in cash in 1960, it would have been worth 70% less in 1980. Not only that, when you compare how the stock market did to what happened with the consumer price index, if you look at both the consumer price index in 1960 and the Dow in 1960, it took 32 years to recover. 32 years. It wasn't until 1992 that the Standard & Poor's had grown sixfold as the consumer price index had grown sixfold during that same time. 32 years to catch up. So if you're invested in just the index fund, is it going to be 32 more years before you catch up today? Think about this. 1966, the blue chip stocks were Anaconda Copper, American Can, American Tobacco, Bethlehem Steel, Chrysler, General Foods, Goodyear, Johns Manville, Owens, Illinois, Swift & Company, Sears, Texas Corp, Union Carbide, U.S. Steel, Westinghouse Electric, and Woolworth. Think about that. Those were the bluest of the blue chip, the most safe, conservative stocks you could buy in 1966. They were the cream of the crop. They were the best of the best. They were the stocks that you could invest in and go to sleep on because they were so safe. They were the bluest of blue chips. But one of the lessons learned was the purchasing power of the dollar took a hit. But the second lesson to learn from the inflation of the 1960s and 70s, so did those companies. Most of those companies do not exist today. Bethlehem Steel, American Can, American Tobacco, Bethlehem Steel, Anaconda Copper, Johns Manville, Owens, Illinois, Swift & Company, Texas Corporation, Union Carbide, Westinghouse Electric, and Woolworth. Companies that were the bluest of the blue became the black and blue stocks. And think, in 1966, the stocks that didn't even exist then, Microsoft, Intel, Southwestern Bell, Home Depot, Walmart, McDonald's, no, all part of the Dow. And then Costco and Starbucks and Genentech and Amgen, Qualcomm, Cisco, Salesforce. Those companies did not exist in 1966. And today, when you look at it, Facebook and Google, Alphabet and Netflix, all those companies have come alive since 1966. There's a lesson to be learned. When inflation hit, what happened with the market is in 1966, the Dow hit almost 1,000, and then it dropped 20%. Then it rose again to 1,000, and then it dropped 30%. And then it rose again to almost 1,000, and then it dropped 40%. And then it rose almost again to 1,000, and it dropped 30%. And then it rose to 1,000. 16 years later, during that period of time, of 16 years, the Dow was at 1,000 in 1966. In August of 1982, it was still at 1,000, having dropped 20%, 30%, 40%, and 20% again. And finally, in August of 1982, it took off and went to over 11,000 by the end of the century. But during that time, had you been invested in index funds, you wouldn't have made any progress. And if you were retiring at that period of time and drawing down on your principal, you would have drawn it down when the stock market was down. And bonds at the same time, bonds were doing the same thing. Bonds were getting hammered and beaten down. You know, bonds like Tacoma City Light. Bonds, which were at 4 and 5%, were trading at 20 and 30 cents on the dollar. I know. I bought some of those bonds in the mid-1980s. Those bonds were actually, as interest rates came down, were increasing at 20 or 30% a year. It was a great time to buy bond. It was a terrible time during that time of inflation. It seems to me that it's a terrible time now to be buying bonds at this time of inflation. There's no place to hide during this time. So what is going on? We've talked about this before and we'll continue to talk about it again, is that this time is different. Things that never happened before happen all the time. It's our theme going forward. You have to think about this in detail and understand. We have a super cycle still continuing. We have inflation still continuing, but you have to think about it in detail. Things that have never happened before happen all the time. You have to know when to hold them. You have to know when to fold them. You have to know when to walk away, and you have to know when to run. Buying index funds is one of those things that you have to know when to run. The stock market did terrible during the last inflationary time period. We're doing pretty well now, and that's different. And maybe this time will be different as well. Although I tend to think that even as the stock market is doing pretty well right at this time, and the market is up over 15%, 16% for the year, that's the average. there's a lot of stocks that are not doing well. There's some that are doing extremely well, some not doing well, which brings us to this theme of know when to hold them, know when to fold them, know when to walk away and when to run. And it is hard to quit. It's hard to take the lessons that we've learned in the past 10 or 20 years and realize a change is happening. Things that have never happened before happen all the time. It's hard to walk away from it. It's easier to hang on, but it's the wrong strategy. And we are coming to a commercial break. And when we come back from that break, we're going to talk about what do you do? How do you know when to hold them? How do you know when to fold them? How do you know when to walk away? And how do you know when to run? And what is really happening? Why is this recession not happening? Why, even though the Fed is raising interest rates, have we not started a recession? Why? When the yield curve is inverted, we haven't started a recession. Why, when we have banks going under and collapsing, are we not seeing a recession? Why are we not seeing the economy drift down into that recession? For some companies, they're predicting a huge recession. Well, they've been predicting that for the first half of 22, for the last half of 22. Well, then the first half of 23, the last half of 23, and soon it'll be the first half of 24. Don't go away. We'll be back and talk about how do you know when to hold and fold them and when to walk away and when to run. I've been talking about themes. I've been talking about early themes, Dow 100,000. I've been talking about the second super cycle. Started Dow 100,000 back in 2010, started the super cycle in 2012. Talked about the end of the secular bull market happening in 2016 because of inflation. And since February of this year, began to talk about a current theme of things that have never happened before happen all the time. It's important to know when to hold them, when to fold them, when to walk away, and when to run. And we believe that that's true theme that you have to understand now. And so what's going on? Since the beginning of last year, in 2022, people have been predicting a recession. Fed's raising interest rates, the yield curve is inverted, and that was augmented when Silicon Valley Bank collapsed. Lots of concerns about commercial real estate, lots of concerns about the community banking system. Lots of concerns about the Fed deleveraging balance sheets, all those things contributing to a reason to think we could be headed for a recession. And many people were forecasting, a lot of gurus forecast we would be in a recession early in 2022. And those who didn't think it was the first half of 22 were saying the second half of 22. When it didn't happen in the first half of 22, they said, well, the second half of 22. When it didn't happen in the second half of 22, they said beginning in 2023. And when it didn't happen now in the first half of 2023, they're saying the last half of 2023 or the beginning of 2024. A recession happening. What happens during a recession? You have to think about this in detail. You have to think about what a recession really is. A recession is when businesses begin to slow down, demand begins to falter because people are buying less. People are not going to restaurants. People are not buying airline tickets. They're not doing vacation. They're cutting back on buying clothes. They're reducing, if they're going out to restaurants, they're reducing the quality of restaurant. Instead of doing the top, they'll do the next one down. They'll continue to drift down so that they're spending less money. People are being laid off, and unemployment is beginning to rise as people begin to be laid off. The unemployment rate is beginning to go up, beginning to see more people unemployed. You're beginning to see people who are fearful for their job being lost. That's the normal situation. That's what we saw in previous recession. But there's a difference between that and what we're seeing now. Beginning with the Obama administration, coming out of the Great Recession, there was a big emphasis on creating jobs. 10% unemployment, you want to create jobs. Continuing that in the Trump administration, there was a continued push to create jobs. Unemployment reached low level. Back in 2009, there were economists that were predicting we'd never get below 7% unemployment. By the Trump administration, we were down to less than 4%. But that focus continued with the Biden administration to continue to create jobs with the CHIPS Act, with infrastructure, and with the bills that were passed, the stimulus through the pandemic, all that geared to job creation. And every administration has been successful in doing that. So successful that today there are 6 million more jobs than there are workers to fill them. And the situation, instead of getting better, is getting worse because we're creating 200,000 or more than 200,000 jobs every month, and we have less than 100,000 workers to fill those jobs. So instead of people being laid off, people are finding that they can quit and get a raise by going somewhere else. During a normal recession, when people quit, they take a lower rate. You see wages falling during a recession. We're not seeing wages fall right now. What we're seeing is wages increasing. The average increase for the bottom 10% or 20% of the workforce, the average increase is 9% per year. 9%. Think about that. Inflation, personal consumption expenditures increasing at 5%. At the low end, low end of workers are getting 9% more now than they got last year. And we're not getting at the high end as much. But the average for a person quitting a job and starting a new job, the average increase is 7%. For the people that are staying in the same job, they're getting 5% increases. So what we're not seeing is people getting laid off and not being able to go to work. Now, there's a small segment of the population where that's not true. I talked to somebody at the Wealth Forum, and she had clients that have been laid off. She works in the Silicon Valley area. And you had people that have been laid off, and in these programmer software engineers being laid off at a salary of $400,000 per year. In order to get a new job, they'd have to take a cut in pay. That's the reality for that. But for the worker that's making $20 an hour, they can go out and get a new job at $25 or $30 an hour. So what we're seeing is that unemployment is not decreasing, it's increasing. Talked to my travel agent, and she said that she's never been as busy as she is right now. People aren't cutting back on their travel, they're increasing their travel. You look at what's gone on, and people are spending more. They're not cutting back on spending. The demand is continuing to grow. And not only that, the most recent numbers are that debt levels, personal debt levels, have been shrinking. People aren't going into debt to buy. They're being able to buy things out of current cash flow. I mean, all of that is creating a situation where the economy is continuing to run, even with the inflation that's going on. And as long as that continues to happen, we're going to have a general economy and a general stock market that continues to go along and move along well. If we reach the point where a recession really sets in, then we really have to look at how do you handle that? And if we look back, there were lessons to learn from that inflationary time of 1966 to 1982. 100,000 invested in McDonald's in 1966 would have grown tenfold to over 1 million by 81. But who in 1966 really believed that a small drive-out restaurant selling 19-cent hamburgers would change the world of dining? Today McDonald's is a household name and part of the Dow. 100,000 invested in Aero Electronics would have grown to over 2 million, 20-fold. But who would have believed that a little radio repair shop in Colorado would have grown to $1 billion major electrical components distribution business? But they recognized the impact of the transistor, and they moved their business to take advantage of it. They realized advanced micro devices dropped from $30 a share to $10 and then began to rise to $300 over that time period. A tenfold increase. $100,000 would have grown to $1 million by 1981. Did it really matter whether somebody bought it at 30 or 10? The stock continued to rise to $17.56. And no, I bought the stock at 10 and I sold it at 30 because I've had a triple in 6 months. I was dumb. I was young. I was dumb. Had I held that stock, 1,756 at the high, but that was when I was first doing stocks. But the thing that you have to understand as well is the volatility is going to be significant because there's a lot of confusion in my industry. People that think they made the perfect trade at the beginning of the year by buying short-term bonds and selling out of their stocks, wrong. If they'd kept their stocks, they would have been up 16%. Instead, they're up 2%. It's a confusing time, and getting it right is very difficult. Looking back and thinking that history repeats is the wrong outlook. History doesn't repeat, it rhymes. There's lessons to be learned. There's ways to do well and even better. If the stock market is up almost 20% in the last year, we were up 48%. We'll be back next Saturday to talk more about money. Stay with us. We'll see you next week.